Hello everyone. In this video, we will be learning about the process of bills of exchange. In previous video, we had already covered concept number 1 of introduction. Now, we will study about concept number 2, bills of exchange. Let's see. Concept 2, bills of exchange. What we'll be learning here, that how the process flows, who is selling goods to whom, what are the main core words which will be helpful in our chapter, that we will learn now. See, understand. Suppose, continuing our previous example, A and B are there two person. Now what is happening? A sold goods to B. So I will write here A sold goods to B. Okay. So first tell me, what can I say who is A? I can say he is the seller of goods, seller or supplier. And who is B? B, you can say B is customer. Simple enough. Now A sold goods to B. We know that B doesn't have anything to pay. So that's why the concept came bills of exchange. Now remember what? Now what journal entry will A pass? A will write B account debit to sales account. Simple enough that we have sold goods to B. What will B write? Think from the B's point of view. B will write purchase account debit from whom he has purchased to A account. Now understand one thing. According to A has sold goods to B on credit, obviously, because B has not paid any cash. So can I say for A, B will become the debtor because A has to receive the money from B, and for B, A will become the creditor. I will just write here for more clarity that A has to receive money from B and B has to pay money to A. Simple enough. Now this is the basic thing what has happened, but we all know that B doesn't have money to pay right now A. Then what does the A do? See, understand this very carefully. A writes a contract requesting B to pay a specified amount after a specified period of time. Now we have to understand this. Be very careful. A writes a contract means what? A draws the contract. A draws the contract. He is drawing the contract. You can say A is writing the contract or A makes the contract. So what we can call A? A is the drawer. A is the drawer of the contract. Now what does that contract called here? The contract is called as bill of exchange here. That is our bill. Understood? Now A draws a bill requesting B to pay a specified amount. What is that specified amount? See, this amount what we had to receive from A, this is called as our specified amount. This is our specified amount. After a specified period of time, what does it mean? It means the specified period of time is the tenure, you can say, which must be less than or equal to 90 days. It is the limitation of bill that you cannot issue bill for more than 90 days. You have to issue it for less than 90 days only, 90 days or less than 90 days. That you will definitely make a payment within 90 days. Understood this part? See, A writes the contract requesting B to pay a specified amount after a specified period of time. That's why that particular contract will be called as the bill. Now, remember this, when you are writing the contract, they has to mention, or you can say A has to mention here in a contract the date of drawing the contract or date of making the contract. Simple enough. Now, after drawing the contract, or you can say after making the bill, A will give that bill to the B. What will B do? B will see and sign the contract and return to the A, or you can say return to the creditor. Now, see and sign, what does it mean? It means B will accept the bill, or you can say accept the contract. The day he accepts the contract, that day is called as date of sight or date of acceptance. Very simple. Now, what happens after this? See, now understand very carefully. A draw the bill requesting B, you have to pay this amount, and he sends it to B. B accepts that and he signs it. After signing, he will return it to the A. Now, understand this thing. B has to receive money from A because we know that now we know since A has to receive money, that bill for A knows that he has to receive money and that's why he is getting the bill. So calls it, A calls that bill as A calls it bills receivable. A calls it bills receivable. Understand? A did not receive the money. What did A do? A made a bill. He got it signed from the B. Now A knows that that particular document will provide him money in future. So for A, it is asset. A has to receive money from that bill. That's why A call it bills receivable. A call it bills receivable. So what will be the nature of this bills receivable for A? It will be current asset. Same like this only for B, we have to understand what is happening. B has to pay money. So B calls it bills payable. And hence for B, he knows that whenever A will bring that bill after 30 days, 45 days or within 90 days, B has to pay money for that. When B has to pay money for that, it means bills payable has become a liability for B. So you will write here current liability. Now A has to receive money. So what is happened right now? See, understand. A sold the goods. So A first wrote B account debit to sales. A first wrote B account debit to sale. Did he get any money? No sir, he did not get any money. He did not get cash, he did not get check, he did not get online payment, nothing. What did he get from B? See, B signed the document. So A can say, I have got the bills receivable. See, we already know, if suppose after B's account debit to sale, I would have got the cash. Then what journal entry I would have wrote? I would have written cash account. I would have written cash account debit to B's account. That is only when I would have received money from B. But the problem here is I have not received money. If I have not received money, what did I receive? I received bills receivable. So I will write here bills receivable account. Now what we can write? Instead of cash or bank, we have received bill from B. For bills receivable, what is bills receivable for us? It is for us, it is asset. Understood this? Now the same thing will apply for B. What will B think? B purchased from A, so he wrote purchase account debit to A. Now if he is making payment to A, what will he write? He is writing A's account debit to, did he give cash? No. What did he give? He gave bill. So he will write to bills payable. He gave bills payable account, and this is how the journal entry should be passed. So we can say we got a new asset here, bills receivable. Bills receivable increased. B was also our asset only. See, understand, when we wrote this entry, B account debit to sale, what is happening? B became my debtor. B became my debtor. Nothing but my asset, and sales is my income. B is debtor. Debtor means asset only. This here it was increasing, but here I can say that the same asset is decreasing. Understood? From here, purchase account debit to A. A was, according to B, if we can think, A was the creditor because A provided B a credit. A was the creditor, or you can say liability. But when we are making the payment, this liability is getting reduced. And new liability is coming, the name is bills payable. Understood? This is our concept number 2 called as bills of exchange. Thank you so much.